Hey everybody, Smart Silver Stacker here. Hope you're doing well. I've got an interesting one for you today because the smart money, well, they're beginning to load up on gold. And why is that? Well, it's likely because we are on the verge of a huge breakout in the price of the precious metals, both gold and silver. So let's get into that today, starting with this news that Michael Berry, famed for The Big Short. You know, this guy, he forecast the subprime crisis, made a killing there, made a huge fortune. Well, now he has just announced that he has purchased a huge amount of gold. He's loading up on the Sprott Physical Gold Trust in his business, Scion Asset Management. So the largest addition most recently announced was in the Sprott Physical Gold Trust. The top new holding, now it represents about 7.37% of his portfolio. It's about a $7.62 million stake. Now, interestingly, he's also loading up on BP. So what is Michael Berry getting exposed to? He's getting exposed to hard assets, commodities, energy, gold, the sort of thing that is going to benefit from the inflation which is about to be unleashed on the economy. And you can see, got this nice little infographic here to give you an idea of how much gold he is holding right now. So in addition to 7.37% of this guy's portfolio is pretty significant. Interesting too, the vehicle he chooses. You know, notice he doesn't go for the GLD. He is going for Sprott's Physical Gold Trust. So maybe something to keep in mind. You know, not financial advice, but you're looking to trade paper gold, that might be the right vehicle to do it with. That is where the smart money is going for the metals. Also, we just got some new data from the World Gold Council. Central banks bought $24 billion worth of gold in Q1 of this year. That is a record for first quarter purchasing, the strongest level of net demand for any quarter on record, using data that goes back to the year 2000. So China, Turkey, India, Kazakhstan, they're driving a lot of the demand. China and India, of course, both members of the BRICS organization. Why are they loading up on gold? Well, they know what's coming, right? They know that there's de-dollarization in the cards. They know the dollar's been weaponized. And they know that the global economy, all these fiat currencies are in a race to the bottom. So smart money is getting into gold in a very big way. Both private investors, central banks around the world, loading up on hard assets. Let's look at the chart here for gold, this long-term chart. I'm just going to let you take a look at that for a moment. You can see there's this long-term cup and handle formation. We've been looking at this for a while. It's broken out, okay? It's consolidating right now. It's near the highs. If you do the math from this pattern, you take the difference between this bottom of the trough here and the top of the handle, you can ascertain a price target by that difference. And the price target that this breakout should lead us to is over $3,000. So right now, gold's under $2,400. So we still have some big gains ahead, even if you just kind of extrapolate your price target based on a traditional cup and handle formation. But we're also, on the verge of a major debt crisis. I've got some news relating to that we're going to go over as well today. Silver, it's a similar story. I mean, we're still bumping up against $30. This blue line right here, we're in the green again today. I mean, it's choppy, of course. We're not just going to blow through $30 like it's nothing. That is a major psychological resistance point. We are looking at a price level where silver hasn't traded above since 2013, $30, and we're right up against it. We're less than $1 away. When silver closes above $30, folks, the gains are going to start coming in rapidly, right? It could be a very short trip up to previous nominal all-time highs for silver around $50. So keep an eye on this, because when gold breaks out, silver is too. I mean, Michael Berry, if you're buying $7 million worth of metal, maybe gold is the better place to put that. I'm not sure. Of course, if you wanted to get physical metal, $7 million worth of silver is going to be, a pretty substantial amount of metal. If you want to get some physical metal, Make sure you check out SD Bullion, today's video sponsor. Right now they got a sale on gold Maple Leaf coins, any quantity, $40 over spot. Half dollars are still on sale as well, $1.99 over spot. Those are probably the two best forms of physical bullion I would be looking at right now. Any kind of sovereign coin for $40 over spot is a great deal. And, junk silver, they're not making it anymore. So that's what I would be looking at. I see someone in the chat here says, there's a bunch of people putting in price targets here. Rolf Steiner says at 30-to-1 ratio, $200 silver is $6,000 gold. Yeah, well, that might be what we're looking at, Rolf. That sounds about right to me. $200 silver might sound a bit out there, but I mean, it seems less out there, right? Now that we've had this breakout from this long consolidation pattern. And when you think about how, bad the U.S. economy is and how much fiat currency the Federal Reserve is going to print in the near future, $200 silver, $600 gold, or $6,000 gold, I think is well within the realm of possibilities. This is the household debt and credit report for Q1 2024. This was just released by the New York Fed. It paints a pretty bad picture for the economy. I mean, you can check it out on their site if you want to get into the details of it. Notably, nearly 9% of credit card balances, 8% of auto loans transitioned into delinquency in this most recent report. And here's kind of a summary of this from BAI, pointing out that these levels of delinquency are the highest in a decade, and yet defaults do not appear to have peaked. Now, why does this matter? I mean, how is this relevant to gold and silver? Well, look, I mean, consumers are coming under a tremendous amount of pressure. They're delinquent. They're facing the highest interest rates in years, and yet they're loading up on consumer debt because inflation has reduced the power of their wages to meet their basic needs. So, when bankruptcies skyrocket, when credit card defaults skyrocket, not only are consumers going to freak out and need some kind of relief, the counterparties to this debt, the banks who are issuing this debt, their balance sheets are already pretty soft because of high interest rates. Well, you're going to start seeing major problems. Let's go into some of the details of this report. Someone in the chat also just said you missed the buying boat. It sailed away. No, I don't think so. Yes, I mean, sure, it would have been nice to buy silver below $26. Would have been nice to buy gold, below $2,000 or $2,100. But I wouldn't think that just because gold is up, like 15%, silver's up about 20% this year, you haven't missed the boat at all, I don't think. I mean, it's, just an opinion, I guess, but it's an informed opinion by all of these facts that we're, going over here. The Fed is going to be printing a lot of money soon. And, if you think that inflation is bad now, if you think that gold and silver are expensive now, just wait. Just wait for what is ahead. So according to Joel Scally, he's an economic principal at the New York Fed's Household and Public Policy Research Division, he says that in the first quarter of 2024, credit card and auto loan transition rates into serious delinquencies continued to rise across all age groups. An increasing number of borrowers missed credit card payments, revealing worsening financial distress among some households. Also, last quarter, the percentage of credit card debt that became seriously delinquent, so this is where they're missing multiple payments, at least 90 days past due, hit 6.86%. That was up from 3% 2 years ago. Total household debt increased by 1.1% in the quarter to $17.69 trillion. And look, I mean, this is why the Fed is going to print, right? Because there's too much debt. There is too much debt in this system. It's all going to get defaulted on if rates are higher. The banks have a huge amount of debt on their books that is going to go bad if rates don't come down. The federal government is running deficits to the tune of $2 trillion, plus the interest is over $1 trillion. The total debt is over $34 trillion. Higher interest rates are not in the cards, folks. Yeah, inflation's up. Sure, it's because they've printed a huge amount of money. They've monetized a huge amount of debt over the past decade plus. But the Fed is incapable of really fighting this, right? I mean, they have to print money or the whole thing is going to collapse. And that's why we're seeing delinquencies on the rise. I mean, keep in mind that, yes, interest rates are high compared to what they have been, but they're not high historically. I mean, 5% federal funds rate, 5.25%. It's not that high compared to where rates have been historically. The difference is that now the debt has gotten so out of control that the only way to pay it off is by devaluing the currency. And how do you do that? Well, you print a lot of money. I mean, that's the bottom line. So, gold and silver, maybe it won't be that they're going up in value. It's just that the dollar that they're being priced in is going to collapse. Among Gen Z borrowers, about 1 in 6 was close to exhausting their approved credit capacity, compared with 4.8% of baby boomers. So 1 in 6 is a pretty huge number, maxing out their credit cards among Gen Z. And, I have some sympathy for younger people today. They're getting a start in an economy that is really at the tail end of this debt cycle, right? And there's going to be a lot of really unhappy people when their credit cards get maxed out. They go bankrupt and they have no savings and they have, no prospects because the economy is so weak. So the political pressure for the Fed to get in here and, quote unquote, fix things by printing huge sums of money it's going to be huge, right? This is what the masses are going to be clamoring for. So prepare for it. Overall, the average USAA savings account balance for members 18 to 26, it's climbed by 28% from 2019 through 2023, but in the last 9 months of 2023, the average savings account balance decreased by 10%. So stimulus money is running out. Sure, you print a bunch of money, you mail checks to people, they're going to save some of that. Savings rates might be up, but now, that's done, right? It's been a while since we've any of us gotten stimulus checks, but they're going to need more. So you can probably expect more of that too. Maybe we'll get some kind of universal basic income scheme with the CBDC soon. I don't know. It's all speculation. I think nobody knows exactly what's going to happen, but I think it is pretty clear that the debt is going to continue to increase and the dollar is going to continue to be devalued. That is one thing that we can see is pretty clear here. At the same time, as of December 31st, 2023, the average monthly balance for a Gen Z cardholder with USAA was 9% higher than the previous year. And on the average month in 2023, 37.8% of Gen Z USAA credit card holders carried a revolving balance. So think about that. You're carrying a revolving balance today. That was a 3% increase, by the way, in the number of card holders carrying a revolving balance. Young people, they're among the most vulnerable because they don't have the assets that older people have accumulated. They're not benefiting from inflation, except for the fact that they're all, racking up these huge amounts of debt. The debt is going to be eliminated via inflation, very likely in the near future. But if you're carrying a revolving balance on a credit card today, you're paying like 20, 25% interest. The interest rates are insane. So, all of these people are going to need a bailout is the bottom line. The Fed's not going to be hiking rates. That's what they need to do to fight inflation, but they're not going to do it, right? Because there'd be pandemonium. Corporations, businesses, governments, nobody can afford the interest on this debt. Here's another piece of Fed data that came out recently, the Philadelphia Manufacturing Survey for May. Just a quick highlight here of some of the points. The survey's indicators for current general activity, new orders and shipments all declined. The latter two turning negative. The employment index suggests declines in employment overall. Both price indexes indicate overall increases in prices but remain below their long-run averages. So rising prices, weakening employment, this is stagflation. This is a preview of what we're going to be getting for the next several years. And it's not good, right? You want to have some hard assets that are going to insulate you from some of the worst of what is about to come. Lower employment means the Fed's going to need to get easy money, but inflation's already high. So, my forecast is that inflation is just going to get really bad, right? The Fed is going to try to stimulate things. Whoever ends up being elected, they're going to rack up more debt. The tax receipts are going to decline because the economy is being hollowed out and the deficits will soar as a result, but they're going to double down on failed economic policies. There's really no way to solve this at this point, right? It's like if you go out on a massive drinking binge, which is what the easy money of the past decade or so following the great financial crisis, it's what it's been in monetary terms, just a huge binge. You can't avoid the hangover, right? But what they're going to do is they're going to give us more alcohol. They're going to, hair the dog or whatever, try to just goose the economy maybe one last time. The problem is inflation is already high, right? And, at the same time, all of this is happening in the financial system in the U.S., all of this weakness, all of this stagflation, all of this massive debt accumulation, which is crippling the economy. As all of that happens, the world is dumping the dollar, right? Right now you have Vladimir Putin visiting China to celebrate the 75th anniversary of the establishment of diplomatic relations between at the time, the Soviet Union and China. And this is what he had to say, among other things. I mean, they've been emphasizing how the two of them are going to stand up to global hegemons. I don't think they mentioned the U.S. specifically, but we all know who they're talking about, and they're emphasizing that they're great friends, lifelong allies. Putin says that the timely decision of Russian and Chinese authorities to make settlements in their national currencies has beefed up trade between countries. That today, 90% of all payments are already made in rubles and yuan. So, the BRICS organization, these two countries, China and Russia, they're de-dollarizing. Their bilateral trade is now almost exclusively in local currencies. We've heard for years that the BRICS are working on a alternative currency to the U.S. dollar, maybe one backed by gold. I mean, certainly if that were to occur, it would be a very positive thing for the dollar price of gold. But even if they just resort to, their own regional currencies, their own fiat, whatever, I mean, it means less dollars are needed in the globe, right? Yes, it is pronounced Michael Berry, I believe. Someone in the chat asked that. But look, the BRICS organization, the UAE, Saudi Arabia, Iran, they all are moving away from the dollar. Last year we had the UAE buying oil from India using rupees, one of their local currencies. You have the purchase of UAE gas via Total Energy by China using the yuan. The dollar's utility as an international means of settling commerce, yeah, it's still the king, it's still the king currency for the globe, but it's losing market share. And when you combine that with the fact that they're about to print so many dollars domestically, the dollar's days are numbered. I mean, it doesn't have to be that way, but that's how it is. That is what the political elites, what the central bankers are doing. They're devaluing the currency, and at the same time, our politicians, their foreign policy, weaponizing the dollar. This is making it less appealing to these foreign players to utilize it. And so this means that China, who has a huge amount of U.S. treasuries, they're going to work on dumping those, right? They've got close to $1 trillion in U.S. treasuries when you combine China, mainland China, and Hong Kong. They're going to be working their way out of those. They have been working their way out of those for years. But now, they might accelerate this depending on how things go. There's a lot of conflict between the U.S. and China, the whole semiconductor chip wars. You've got Taiwan as a major issue. Russia, obviously, at odds with the West and NATO in a pretty significant way as a result of the conflict in Ukraine. And none of these dynamics are going to change. I mean, you've got Iran, right, at odds with Israel. So Iran now firmly in the anti-U.S. hegemon camp. I mean, that's been the case for a while, but that is heating up. They've got a lot of incentive to undermine the dollar in the region, and they sort of have the ability to do that now that they are at peace and both members of the BRICS nation with Saudi Arabia. So look, the situation is not looking good for the dollar. The dollar's not necessarily going to go away. It's not going to be supplanted entirely by the ruble or the yuan. I get it. People like to always comment like, well, those currencies are just useless fiat too. Yeah, sure they are, but there is an alternative, right? It's gold. I mean, gold is probably going to be the thing that really supplants all of these fiat currencies. And when it does, this price right here, $2,300, is going to look really cheap by what, is coming. And so, look, I mean, smart money's loading up on gold. Central banks are loading up on gold. Michael Berry's loading up on gold. I've a little bit loading up on gold, mostly on silver. But look, I think that silver is going to catch up to gold. It's got a lot of ground to cover before it does that. But that's historically what happens during these bull markets, right? First gold goes, then silver catches up by the end. Silver's more volatile. We are seeing that a little bit with the most recent rally. The gold to silver ratio has come down from its highs, but still very high. So, you want to be a little more speculative. Maybe silver's the way to go. If you want to just go for what the central bankers and the Wall Street smart money is going for, maybe gold is the way to go. But either way, they're going to be a much better alternative than saving in the U.S. dollar, buying, a U.S. Treasury for under 5%. But let me know what you think in the comments down below. Is now the time to be loading up on gold? Is Michael Berry, does he know something's coming here? What does he know is coming, right? Does he know that a big dollar devaluation is on the way, inflation? I don't think it's too hard to see that is what is in store for us. But leave me a comment down below to let me know what you think. Stay safe out there. Happy stacking, everybody. I'll catch you next time.